Well, a lot of people over the years, I mean, if you look at 85% of mutual fund investors, yes, they do buy emerging market benchmarked funds, thinking that they can actually adequately time the market. More often than not, a lot of investors made timing mistakes. The essence of our approach is quite different. We see emerging market fixed income as a very diverse asset class from which we can potentially extract any kind of risk-return profile that we want without being wedded to market timing. So essentially what we consider is that there are various sources of returns or performance engines, as we like to call them, which are essentially the income engine, which historically has accounted for 90% of your returns in this asset class. A lot of people don't realize that. Alpha generation, which comes from a number of very idiosyncratic situations, stories, event-driven special situations that can give you sources of return which are less correlated to market indices. And eventually, if you want to generate sustainable capital gains, we strongly believe that yes, you should try and time the market, but time it efficiently with a full understanding of both fundamentals and technicals, which is a massive criteria when it comes to taking an investment decision in this space. And if you're going to engage into beta timing, you should do it with liquid assets. And that's what matters. So the combination of income, alpha generating assets and beta timing assets is really the way we chose to approach risk taking in this asset class. Yes, I think it's an interesting illustration of how the flexibility that our framework and our process gives us can be accretive to the portfolio. So yes, we had been away from Argentina throughout the first part of the year, not seeing any silver lining in terms of inflation improvement, growth improvement, and observing the loss of support of the current President Macri. Now, from late May onwards, we started to see some room for becoming a bit more positive. Base effects were starting to work in favor of inflation expectations, growth expectations, helping the population at large, gaining some confidence, at least the very initial stages of a build-up in confidence, which was translating as of late May, early June into better opinion polls for President Macri. So we decided to onboard some Argentina 2018 dollars for about 2% of the portfolio. We later added some pure FX ideas, and then later on a long exposure to a local currency inflation linker bond at 28% real yields from late June onwards. So that struck us as a good time to try something on Argentina on a more tactical basis. So by mid-July, we were running close to 5% risk in Argentina across hard and local currencies. Now, going into the primary election on August 11, we didn't have any clue. We were not more informed than anyone else. We were, like everyone else, expecting a benign outcome. Yet something that struck us is that we were moving into a part of the year, August, which is typically bad for liquidity. The global community was questioning the Fed attitude to monetary policy. And then on 1st of August, we saw a surprise extension of tariffs to all Chinese imports by President Trump. So it struck us that the environment was becoming a little bit more hairy, but also the risk-reward of owning the Argentina position through the election, where taking and onboarding the technical features of positioning there, which is also an important factor in our approach. The fact that everyone was long and happy and expecting a benign outcome struck us at not the most optimal risk reward going into a binary event. So without having any clues as to the conclusion of the event, we felt that sitting on profits in a uniform market landscape when it comes to expectations and positioning, the risk reward wasn't there. So we just flattened all the position. That's the flexibility that our process gives us. And that was, in retrospect, the right decision to take. I always think there are many opportunities in that asset class. So It's not a question of market timing. So for the record, we still believe we're actually in a recovering market after the bruising experience of last year. We're potentially hitting a roadblock currently because of a number of event-driven issues relating to trade, geopolitics, and more generally, populist decision-making processes. So as investors, what we have to learn to live with is a more event-driven environment. Policy making is less predictable than it used to be. Eventually, it still spooks many investors. Eventually, as a community, we'll get used to that. But that also means that you have to be much more tactical and nimble in the way you operate. That's also part of the reason why we think benchmarks are increasingly irrelevant or less relevant, because they only represent a basic average of multiple situations, and the dispersion of returns within benchmarks is here to prove that point. So eventually, we think the current policy put, which is at play across all developed market central banks, from the US to Europe to China to Japan, and something which is a bit neglected, which is the fiscal spending angle of things, which is also coming into the picture now, ensures that nothing too bad can happen to emerging markets. It provides policy flexibility. The amount of negative yielding markets makes EM, by comparison, relatively compelling story. Everything is relative. Nothing is really absolute. So that's very much our view at the moment, that as an asset class, there are still many opportunities, many value opportunities to be had in emerging market fixed income. The art is very much how you catch them. And you just can't be passive and placid, just waiting for the market to be lifted. You have to make use of all the potential drivers to your portfolio.